Welcome to INN's coverage of PDAC, which runs online this year from March 8th to 11th. You're about to watch my interview with Rick Rule. It was filmed on March 1st, and it covers Rick's thoughts on gold and silver, as well as unloved sectors that he thinks investors should keep an eye on. We'll be posting all of our PDAC content right here on our YouTube channel, and we encourage you to follow along and enjoy. I'm Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule, veteran investor in the resource sector and recently retired from Sprott. Thank you so much for being here online with me. Great to talk to you as always.
Charlotte, as always, thank you for having me on your network. I enjoy these interviews.
Yes, and I think the question to start off today is what our introduction of you has brought up. You did recently announce that you'll be retiring from Sprott, and let's get into what exactly that means for you, because I know you'll still be involved with the company in some ways.
Absolutely. What I've decided to do is resign those positions, which frankly don't bring me joy. Things like corporate management. I've resigned from all of the supervisory and management roles at Sprott. I will continue to manage money as a advisor in various Sprott products. I will continue as a mentor for the people who handle individual client accounts at Sprott Private Wealth. I will remain the largest shareholder of Sprott, a member of the board of directors, and probably importantly, as the largest private client of Sprott. I'm taking the Sprott US media business, the public outreach media, with myself. That will be branded Rule Investment Media. So increasingly, Charlotte, you and I will be colleagues, and I look forward to a more public role at Sprott, less constrained by the necessary regulations imposed by FINRA on securities industry activities.
Well, that sounds very positive for you. It sounds like a great move. Now, this interview that we're doing right now, we're going to be airing it during PDAC, which is next week. And so to start off, I thought that we could look back on PDAC a year ago. We were sitting in the convention center with thousands of other people, wondering what was going to happen with COVID-19 and the mining sector. So a year on from that time, how is the mining industry done in your eyes? How has it fared?
Two caveats. One, I think that the mining industry, like most other industries, didn't properly understand the impact that COVID might have on all of our lives. That said, I think when the mining industry came around to recognizing what hit it, that it did a superb job in securing the facilities and ensuring worker safety in a suboptimal circumstance, which is to say crew buses working together in constrained remote environments. I'm frankly astonished by the performance of the mining industry under very challenging times. I'm proud of the men and women who managed to make the industry a lot safer than I ever anticipated that it could be. And I'm delighted, frankly, that the veteran managers of my age have given away to a younger cadre who I'm almost certain were responsible for the industry's wonderful response. Think about, as an example, just to pull one out of the air, the construction activities of Ivanhoe and Katanga, a frontier market, and the fact that 5,000 people, many of whom are new to industrial employment, were able through this contagion to limit transmissible diseases and continue to build this deposit with no negative impact either to the workforce or to the communities that they served. This is really unparalleled, I would say almost in the history of industrial activity. And it's something that we all can be, I think, very proud of.
Yeah, I think those are some great observations. Now, over the last year, of course, coronavirus has been a big topic of conversation in many interviews I've done. As we look ahead at 2021, the next 12 months, what themes aside from that do you think may affect the mining industry?
Well, I think the important thing that has happened in mining as a consequence really of COVID-19 is twofold, both having to do with policy responses to COVID. One great government motto is never let a great crisis go to waste. And COVID was one of the greatest crises that we have ever had the opportunity, if that's the right word, to take advantage of as the government. The policy response to COVID, which is to say more quantitative easing, artificially lower interest rates, higher debt and deficits, have been very good for the precious metals mining side. On the industrial materials side, and of course, these responses aren't limited to COVID. They're just an excuse for the government's ability to debase the currency. On the other side, the incredible amounts of liquidity which have been pumped into the market have created what I suspect is artificial stimulus and led to the reflation trade in copper, in oil and gas, and other things. One needs to be very careful in terms of speculating in economic booms that are engendered more by liquidity, particularly artificial liquidity, than other things. So I suspect that the response to the COVID-19 virus is a sort of a hydra-headed monster, some good, some bad. Looking forward, I think we need to continue to consider COVID. But I think the most important issues for us going forward will be really whether or not the economic activity that we're currently enjoying is sustainable. That is, whether the economy needs a bit of a reset after 10 years of relatively benign economic climate following the 2008 collapse, and also in reflection of increasing citizen sentiment around the world away from free trade and to balkanization, which normally makes the world poorer rather than richer and constrains opportunities. If we can continue with the benign economic climate that we have been enjoying, irrespective, I think, of its origin, then the near-term outlook for the commodities business is good. My own suspicion is that the economic recovery that we're in the middle of will falter. And if that happens, my suspicion is that the reflation trade that we see will be postponed 2 years or 3 years. But make no mistake, Charlotte, we've talked about this, you and I, for years at PDAC. A decade of underinvestment in exploration and construction and development will hamper the supply of industrial commodities for a fairly long time. That means that we will almost certainly, either sooner or later, enjoy the type of trade across industrial materials and energy that we saw in the 2000 to 2006 or 2007 bull market. It's really a question of pay me now if the economic boom continues, or pay me later if this boom falters, but the supply-driven constraints rise later in this decade.
Right. So that gives us some idea of what could be coming next for industrial commodities. What about gold? I think that the last time we spoke, which was around November, December, the price was not as low as it is at the moment, but lower than it was this past summer. And you told us that it was perhaps part of a cyclical decline in a secular bull market. Are we still in that kind of a trend?
I think we are. We talked at the time and in the interview before that about the things that drive the gold price. And in my opinion, the most important driver of the gold price is real interest rates on other savings instruments. During the period of time that has coincided with the decline in the gold price and the more precipitous decline in the prices of the gold equities prices, nominal interest rates on the US 10-year Treasury have doubled, going from 75 basis points to almost 150 basis points. That strengthening in the US interest rate and the US 10-year rate has strengthened the US dollar, has strengthened the attractiveness of conventional savings products, and weakened investors' perceptions around the need for gold. I would note that the US 10-year interest rate is still, in real terms, negative, which is to say investors receive 145 basis points in a currency whose purchasing power is depreciating by 160 basis points a year, which is to say that the value proposition offered up by the US 10-year Treasury is that you lose 15 basis points or 15% of 1% of your purchasing power annually. Still not an attractive outcome, but certainly a more attractive outcome than losing 50 or 60 basis points annually. If the economy is strong enough that the Fed can allow the interest rate to rise, this will continue to be difficult for the gold price. My own supposition is that the increases that you have seen in the US 10-year Treasury rate will filter through to the rest of the economy, raising the 30-year mortgage rate, raising the finance rate on new automobile purchases as well as other consumer purchases, and of course, raising the interest rate payable on federal, state, and local debt in the United States. So my own belief is that the interest rate rises that we've seen are, at least in the near term, unsustainable. It's important too, Charlotte, to remember the lessons that you and I have discussed in the past about the gold equities market, particularly as described by the Barron's Gold Mining Index, which is to say that even in secular bull markets, such as the one that I believe that we're in, cyclical declines can occur. And these cyclical declines, if one looks back at history, are frequent and fairly deep. A 25% decline in the equities index, never mind it isn't rare, it's common if you look back over 50 or 55 years of history in the gold equities index. And I would suggest to investors that can't stand that volatility that they simply exit the sector. It's a factor. It's part of participating in the sector. In fact, periodic declines, if you believe that a bull market are intact, in other industries would be described as sales. And if you are of a mind to take advantage of a sale, these cyclical declines are good things for you. I, for one, have been using this one to increase my positions in those gold equities that I feel are undervalued.
Okay, I think that does help it put in context for some investors out there. Now, another topic that we've talked about in the past is Robinhood investors, and I don't think we can skip over that one today because of what's been going on over the past month with silver, GameStop, Wall Street bets, all those kind of things. Do you see, I guess maybe first we can ask, what do you make of that activity? I wonder if you think it is positive in that maybe it's opened up more people's eyes to investing, speculating, or perhaps, I don't know if negative is the right word, but do you think it's maybe shown people a little bit of like leaving them disillusioned, seeing that Robinhood can step in and, take things away? So what do you think there?
Charlotte, I think it's wholly positive. Having said that, many of the younger people participating on Robinhood will learn some harsh lessons, which they would have learned anyway. The idea that so much speculation today is narrative driven means that many young investors are employing a technique which I refer to as got a hunch, bet a bunch. Now, in that circumstance, most of these young investors will be punished. But being punished sooner rather than later, if one learns their lessons, is not a bad thing. The much more important lesson is, as you describe, this is introducing hundreds of thousands of young people to the savings and investment process. More importantly, what you're seeing, Charlotte, I think is the continuation of a phenomenon that brought you to us, which is to say, the democratization of investment information. Investment information used to come to the public either from the research departments of big investment banks or from the media conglomerates, the BNNs and the Wall Street Journals of the world. The Charlotte McLeods didn't exist, never mind the peer-to-peer distribution of investment information that takes place on places like Robinhood or Reddit. The idea that we are democratizing the distribution of investment ideas and investment rationale, including by peer-to-peer, I think over the next decade will be wholly good. My suspicion is that younger people who rely on opinion leaders whose investment processes are unknown to them is in the near term dangerous. And I suspect that these young investors will be spanked, just as I was spanked when I was their age. I think this spanking, while painful, will be good and will make them better investors over the course of a decade, albeit not over the course of months. So I suspect that there will be all sorts of hue and cry as some young people lose a lot of money in this venue. But, separating a fool from his or her money is a necessary process in making them less of a fool.
All right, sounds fair enough. Now, connected to all of this Robinhood Wall Street bet storyline is the silver squeeze story, which has brought a lot of attention to different silver investment vehicles, including PSLV, which is the Sprott Physical Silver Trust. So I wondered if we could talk a little bit about that. Maybe you could give a sense of the demand that you've seen coming toward that.
Yes, with the caveat that I'm a Sprott director, and the Sprott Physical Silver Trust has an evergreen prospectus in place. So I'm a bit limited as to what I can say. I don't want anybody to construe this investment as investment advice because, of course, I'm conflicted. I'm the largest shareholder of Sprott, and to the extent that people invest in our products, I make money. So I would encourage, first of all, anybody who is interested in the silver market and in the Sprott products to go to the Sprott website, where you can learn about the architecture of that product, particularly the architecture of that product relative to other silver investment products, the ETFs with which it is a direct competitor. I can say this, the architecture of the Sprott product done by Eric Sprott was one that envisioned the current circumstance that we're in almost exactly. The idea, as an example, that our product, in terms of assets, can only have a little amount of cash necessary for operating expenses, and the rest has to be physical silver. It can't be deposit receipts. It can't be delivery receipts. And that type of thing is very well regarded in the market now. Getting to the broader part of your question, the structure of the silver market makes it unusually interesting to people who want to use investment market dynamics to trade, specifically the fact that on the silver market, so much activity takes place in the futures market relative to the inventory available for good delivery. I have been told that on some days, the futures market trades well in excess of 200 times the amount of silver available for settlement in good delivery. And I think that's the sort of thing that the Reddit group was looking at in terms of their ability to take advantage of a market. I would note that the market capitalization of the silver futures market is much larger than the market capitalization of GameStop. So this is a much, much bigger game for much, much higher stakes. I would note, too, just as an old responsible adult, that trying to corner the silver market is not a new movie. The Hunts tried in the 70s. And the people behind the futures market, should they wish to do so, could change the rules of the game, very much as they did with the Hunts, or could even theoretically suspend the silver market and cash settle rather than physically settle at a price that they may or may not determine arbitrarily. Looking longer term, I believe that the wind is in precious metal sales, which is to say that the precious metals will trade higher. My experience has been in the middle and later part of a precious metals bull market, silver outpaces gold. It moves further, it moves faster. So I think these young people are headed in the right direction. Whether or not they're headed in that direction for the right reasons is a very, very different question, one that I'm afraid I'll have to leave to history to note.
Right. Definitely a question that we see a lot on our channel is, what does this actually mean for the price? For you, would you say it's more of a flash in the pan than a long-term factor here?
I think that the attempted short squeeze, well, it'll be a flash in the pan unless it isn't. The truth is, had you and I been having this discussion 6 weeks ago, and if you had asked me a question about a shortness of physical silver, I would have said, well, there's only a shortage of physical silver in retail products, which is to say 1 ounce products to 1 kilo products. 400 ounce products, 1,000 ounce products were freely available. And in fact, Sprott has managed to access over 30 million ounces of silver to accommodate the increase in net asset value of our fund. I'm informed that just in the last 5 or 6 days, even wholesale quantities of silver has become tough. Our trading desk and the trading desks of the big institutions that serve us have done a very good job of sourcing silver. I think we may be the largest client in the world for purchases of physical silver, which means that we get extraordinarily good service. But it is interesting to note that even at the wholesale level, silver, it's becoming tougher for us to accommodate that. So my first instinct was that the silver short wouldn't work simply because the size of the silver market was too large. Except for it would appear that there is some anecdotal evidence that it is working. What's useful about this is it causes millions of people who haven't thought about silver for 40 or 50 years, or in their young lives have never thought about it at all, to think about the subject, because silver is a very interesting investment class and a more interesting speculative class. And to the extent that 2 to 10 million, as an example, investors or speculators get interested in silver, some number of them will continue that interest, which can only be good for the silver market and the silver equities market, irrespective of the near-term outcome with regards to a prescribed silver short.
Okay, very interesting. Now, aside from gold and silver, which of course we have to touch on, what other commodities do you have an interest in at the moment?
Well, you'll recall the list from our last interview, which was broad. The problem is that the market capitalizations of those sectors have increased dramatically. I remember telling you that $40 oil was unsustainable and the oil price would have to rise. And if it did, that the share prices of the oil stocks would have to rise. I thought this might take 2 years. It took 2 months. Uranium is a sector that you and I have talked about for at least 2 years. The price of all the uranium juniors has doubled or tripled, which means that they are precisely 2/3 less attractive than they used to be, which is to say the price of the equities has gone up, but the price of the material, at least in the spot market, hasn't gone up. My belief is in the very near term, the reflation trade, which is to say base metals, energy, uranium, battery metals, all of those types of things are overhyped and there's too much narrative around them. Should you buy them today, my suspicion is 3 years from now, you'll be happy, and 3 months from now, you'll be sad. And so whether or not it's advisable to do that really depends on your outlook, your duration, and your psychological capacity for volatility. I believe, by contrast, and this is a belief, Charlotte, I believe, by contrast, that the increase in the interest rate is probably overdone, which means that the decrease in the sentiment and the gold price is probably overdone. Relative to today's gold price, the enterprise values to net present values and the enterprise values relative to EBIT in certain sectors of the gold industry, particularly the single asset mid-cap producers, these are the cheapest that they have been in 40 or 45 years. And if I'm right about the fact that the rise in interest rates will stall out and decline, that would mean that the attractiveness of gold and hence the gold equities would increase. So I myself, in the last 10 or 12 days, have been looking for bargains in the mid-cap gold space and taking advantage of the current decline in the quotes to add to my personal positions.
All right. And yeah, of course, I do remember you mentioning oil and gas, uranium, which we've talked about for quite a while. I think you've mentioned agriculture in the past as well. What does it tell us that those sectors seem to be moving forward in perhaps a quicker way than you had envisioned?
Well, I mean, one interpretation would be to quote an entertainer from before your time, Patsy Cline, and simply say, I was so wrong. That's one alternative. I think a fairer alternative would be to say that the economy right now may be unsustainably strong. Unsustainable because it is driven more, I think, by liquidity, artificially low interest rates and quantitative easing, than it is by increases in wealth, productivity, or trade worldwide. If that's true, and the current benign economic climate gets replaced by something that's somewhat more challenging, I think that you would see commodity prices and hence the price of commodities producers decline apace, in which case my timing would be more accurate as opposed to less accurate. Make no mistake, Charlotte, for reasons that you and I have talked about literally for years, in our prior interviews at PDAC, society has underinvested in the supply of basic commodities for a very long time, at least a decade, and some would argue for 3 decades. And this will come home to roost. Whether or not that benefits investors in the next year is a very different question, but it will benefit them certainly over time. It's important, I think, to note for your younger listeners that some understanding of the arithmetic of investing is important to replace the narrative. If a commodity that's necessary for our way of living is selling at a discount to the cost of producing it, which is to say, if the industry is in liquidation, there are only 2 outcomes. Our way of living will change for the worse, or the price of that commodity will go up. In the case of oil and gas, I think my direct quote to you and your listeners last year was either the price of oil goes up or your car won't start. What do you think is more likely? So really, investors need to concern themselves with that part of the narrative, and they need to determine for themselves whether the benign economic climate that we enjoy today is a function of increases in real living standards, or rather a function of artificial liquidity and artificially low interest rates.
Yeah, a great reminder on that one. Are there any other themes or elements like this that you think that investors or speculators may be missing as they go about their research and things like that?
Well, other than the attractiveness of the mid-cap gold equities, particularly the single asset producers, and more particularly Australian producers, I think the other sectors that are out of favor now include agricultural minerals, which is to say potash and phosphates, and the perennial underperformer, which is water. Unfortunately, there's almost no way for investors to play the water game, particularly Canadian investors. You know, your challenge up there is to make the water go away, not to have it. And so the vehicles are very seldom Canadian. But certainly the agricultural minerals sector hasn't been getting a lot of love, and I think it deserves much more love. Whether it'll move this year or not is a different question. But it's interesting to note that in the US, as an example, farm gate commodity prices for soft commodities, wheat, corn, beans, things like that, is up 40 or 45%. This hasn't translated yet into dramatic increases in the income statement of farmers, and it hasn't translated into increased farm prices. But what it will do relatively quickly is lead to increased utilization of inputs, which is to say, agricultural minerals, increased fertilizer loadings, increased utilization of cropland. So I think that the 3, 4, 5-year outlook for things like ammonia, potash, phosphates, the necessary components of the green revolution, will do well.
All right. So those are all definitely things that you've mentioned to us before. And I don't know, everybody always wants to hear from you about gold and precious metals. So I don't know if people are actually listening and taking a look at these other things. Do you think that people who are more focused on precious metals have the tools they need to start entering these other sectors? Do they require a different set of criteria when you look at stocks over there?
I think people intuitively have the right ideas, but it's very difficult to make your brain override your heart. It is very true that narrative is justified by price performance, which is to say, if you know intuitively that the price of uranium has to go up, when uranium stocks double, perversely, they become more attractive in people's mind. If a stock goes from $2 to $4, and the underlying fundamentals haven't changed, the stock, pardon me, is precisely half as attractive. The same value proposition is offered up at twice the price, but people are twice as interested. You know, I've been pounding the tub on the uranium business for at least 4 years into either an echo, which is to say people didn't care, or to overt hostility. Because when people thought of uranium, they thought about Chernobyl, Fukushima, and 3 Mile Island. Now that the price of the juniors has doubled and tripled, I get thousands of inquiries around an asset class where the price is less attractive than it used to be. It's a sort of I guess it's human nature. It's important that young investors in particular who are driven to a narrative examine the arithmetic of the narrative rather than merely the broad story.
Well, and I think the other thing perhaps about entering one of these sectors, especially such as oil and gas, is you're probably going to be looking at larger companies than you might want to if you're looking at gold. I know a lot of our audience is interested in the juniors and they don't maybe see the equivalents in these other sectors. So what can you say about that?
Well, I think it's interesting because traditionally the smaller oil companies have been viable, which is to say you have a $100 million market cap that you can analyze in conventional measures, debt to equity, free cash flow to debt, cost of capital versus return on capital employed. I think younger investors shy away from sectors that require them to do work, that require reliance on arithmetic. And they crowd into sectors where you can have a $300 million market cap where you don't need to pay attention too much to fundamentals because there aren't any. There's merely a negative. This always, over time, has an unhappy ending. And investors who concentrate in sectors where there are observable fundamentals over time will always do better. It's interesting, Charlotte, if you and I were at the PDAC and cohabiting your booth, we would field literally dozens of calls a day, discussions a day around share prices. People have an interest in prices, but the truth is that the price information in isolation, without any opinion about the underlying value, is meaningless. Money is made on the delta between price and value. And if you only have price information and no value information, the price information that you have is meaningless, but people are fascinated by it. Over time, successful people get disabused of the focus on narrative and the focus on price, and they begin to be more consumed with the sense of how do you determine present values and maybe more importantly, future values. And that's always a healthy process, although it's invariably painful for young investors who are learning the lessons on the way.
Do you think you could talk a little bit about some of those metrics that people might want to look at? Because I do think, I can't tell you how many times I've heard when you're looking at a mining company to consider management, things like that. It's rare that people will give you a tangible number to look at or things like that.
Yeah, I mean, to me, the most important number is fairly inexact, which is to say net present value. If you begin with the first document that describes that, which is the preliminary economic assessment, understand that it is preliminary, which is to say it's going to change. But if you have some indication that the project, as an example, may be worth $1 billion, and that the project will cost $300 million to construct, if you understand something about the value of the project relative to the market capitalization, then you begin to understand how the price can conflict with value. Once you begin to understand in a very broad sense what the project value is, you need to look at the inputs. And by the way, you don't need to get it right. You'll never get it right. You just need to get it more right than your competitors, most of whom don't care. It isn't really a tough test. As an example, a net present value calculation that was done at $1,250 gold is going to be more conservative than a different company's net present value calculation that was done at $1,750 gold. So you're going to have to begin to develop the ability to do apples to apples rather than apples to oranges comparisons. You also need to determine the interest rate that was used. Net present value means that you discount the valuation from the time when the cash flow is going to start until today, using a variety of interest rate calculations. Traditionally in the resource business, we use 10%. The oil industry still uses 10%. The gold industry sometimes does undiscounted, which is to say no valuation discounts at all, or a 5% discount, which says on the face of it that oil companies are always undervalued relative to gold companies, based as an example solely on the discount. In junior mining companies, the process becomes as much art as science. And there you do have to take into account non-financial metrics, which is to say managers, people who have the ability and the experience and the access to capital to turn an interesting prospect into an interesting project. That is, to advance it to the point where you can begin to do economic calculations. And in that circumstance, an understanding of the value, the intangible value of management is important. Has the management team been successful before? And particularly, have they been successful in an activity that's closely related to the activity that they're engaging in today? We've talked about this exact example before, Charlotte, but when one's prior success involved managing an operating gold mine in Archean terrain in French-speaking Quebec, and the task at hand is exploration rather than production, in very young accreted terrain in Spanish-speaking Peru, yes, they're both mining, but they're very different activities. So understanding in a speculative sense that the intellectual capital becomes more important in the near term than the physical capital means that you need to develop a very specific sense of what management success might constitute for you. This is a very long discussion, and it's a discussion that I'm actually looking forward to doing a video series on now that some of my time has been freed from other pursuits within Sprott, which have been less interesting to me.
All right. Well, certainly we'll look forward to that video series. And of course, not to knock on the management variable at all, but it does help that you put it into a little bit of context with those other numbers. So thank you for that.
A pleasure.
I think, yeah, and I think to wrap up here, I would just ask if you have any final words for the audience.
Well, the same that I always do. Keep learning, keep learning. Got a hunch, bet a bunch is a recipe for failure, except for by accident. I love to engage in dialogue with your customers. And in order to encourage that, I would like to reiterate my offer to rank your listeners' natural resource portfolios. The best way to stimulate a conversation is to keep it interesting to people, and nothing interests them as much as their own fortunes. So go to a website, sprottusa.com/rankings. Enter your natural resource stocks on the web form, and I personally will rank them 1 to 10, 1 best, 10 worst. I will comment on individual issues where I think my comments might have value. And if your listeners include in the comments and questions section charts, I will include too a copy of the Barron's Gold Mining Index, the longest running and most inclusive gold equities index that I know of on the planet, and also a 100-year commodity chart, which shows just how cheap commodities are on a historic basis when compared with other savings and investment asset classes. Once again, sprottusa.com/rankings.
Perfect. Well, thank you for that offer. And as usual, we'll leave a link in the description of the video as well, so people can click through. Yeah, thank you for the offer. That's great. I hope people do take advantage of that.
And I look forward to someday resuming these interviews at PDAC in Toronto live. But until then, Charlotte, thank you for having me back on.
Thank you so much. And yes, look forward to a future where hopefully we can see each other in person. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rick Rule.